What's going on, guys? Matthew Minnis here. Welcome back to the channel. In today's video, we're going to talk about three popular income ETFs, QYLD, RYLD, and XYLD. We're going to go over their 2021 performance, dividends, asset value increases or decreases. We're going to talk about an extremely large dividend that happened at the end of the year for each of these. And then last but not least, as in all my videos, I'm going to give my personal opinion on what I'm going to do in 2022 when it comes to investing in this specific category. Now, before we start the video, I do have to disclose that I am not a financial advisor. These are just my opinions, and I hope you can take the information from this video, do your own research, and make your own choices when it comes to setting yourself up for success in the future. Now that we got that out of the way, let's get right into the video. For a quick little introduction, before we get into the spreadsheets, I want to talk about these three Global X ETFs. Now, we've talked about them in other videos, so I'm not going to get too in-depth, but I do want to just quickly describe the differences. So we have the three XYLD, RYLD, and QYLD. All three of them follow a covered call option strategy in order to generate premiums for the investors. Now, the dividends or distributions are paid out monthly, and each one follows a different index or seeks to generate returns that are similar to the index that they follow. So for instance, we have QYLD with the NASDAQ 100, we have RYLD with the Russell 2000, and then we have XYLD, which follows the S&P 500. All three of these are passively managed ETFs. All three of these have a 0.6% expense ratio, up until March at least, where $60 out of $10,000 investment would be your expense. Now it's time to look at the results. And I must say, surprisingly, QYLD ended up being the worst investment in 2021, even though it is by far the most popular income ETF of the three. So let's take a look at the spreadsheet that I made. So right here we have the three ETFs. We have QYLD, RYLD, and XYLD. We're going to go through each one individually, and we got some important information here. So we have our dividend yield for the entire year of 2021. We have our percent yield, and this is monthly, not annually. We have our share price volatility. What that means is if we had invested on day one at $22.83, if we were to cash it out, just one share on January 1st, 2022, then we would have lost 2.67%, not including any dividends. So as you can see, the price went down. When we go over to RYLD, it is an opposite story. The price went up. It's gone up almost 10%, 9.12%. And when we go to XYLD, it's a similar story as well. It actually is up 10% if you had invested on January 1st, 2021. So for all these examples, we're going to use an investment of $5,000. So just pretending we put $5,000 into each one on January 1st last year, where would we have ended up today? Well, let's start with QYLD. So if we put in $5,000, we would have ended up with 219 shares. And each month after that, we would have gotten a dividend yield of 22 cents per share. We would have been able to purchase around 2 more shares. So now we have 221 shares. But our market value of our total investment has gone down with dividend reinvestment, and that's because the share price has gone down. So even though we have more shares, we have less market value. However, at the end of the year, we kept reinvesting. We went from 219 shares up to just under 250 shares, and we gained around $521. So our annual dividend yield was 12.7%. Our average monthly yield, if we average it out over each month, was 1.06% per month. And then our total investment return, which includes the dividend yield and the asset appreciation, or in this case, depreciation, we end up with 10.5%. So our $5,000 investment turned into $5,500, which is still pretty respectable. Fun fact, when we look at the actual NASDAQ 100 returns, that increased by 26.6%. So you would have had a significantly higher return if you had invested in something like QQQ, for instance. So let's go over and look at RYLD. RYLD is a bit better of a story. As you can see right off the bat, the total investment return is 23% versus 10%. So it's almost double the return. We had 222 shares on day one. We continued to buy our shares. We ended up with 251 shares. Share price is very similar to QYLD. However, the asset appreciated substantially. Now, let's not be naive. There was a reason for this. The Russell 2000 index has a lot more volatility in the index because they're smaller cap stocks. And with that, the price was pretty low at the beginning of the year. A lot of these were still coming out of the COVID recovery phase. So there was a lot of room for the assets to grow. We did have an increase, but when we combine the dividend yield of 12.3% with that asset increase of 9%, we end up with a 23% return on our initial investment. So our $5,000, if you'd invested in RYLD instead of QYLD, you would have made $1,100 versus only $500 in QYLD. Let's go on down one more. And we have the XYLD. Now remember, this one goes off the S&P 500. And the S&P 500 had a whopping 28.7% return in 2021. Wow. However, our total investment return on XYLD is a very respectable 20.89%. The monthly dividend yield is a bit lower, around 0.75%. It's definitely not up with the others. However, we do have some decent asset appreciation as well. Now, there are two more things that I want to discuss before we go into my personal opinions, and those are the initial cost when the fund came out. So QYLD, I believe, came out in around 2014, and it was at $25.50 a share. So today, or a couple days ago, it was only worth $22.22. So it has dropped 12.9% in value. The cost of RYLD when it came out was $25, and it's dropped about 2%. And the cost of XYLD was actually $39.75. So it's actually increased almost 28% since it came out. So that is something important to keep in mind, is there is the chance for income ETFs to continue losing market value when it comes to the cost of the actual shares. However, we need to remember that the point of these funds is not to provide the best growth in terms of portfolio value, it's to provide income on a monthly basis. So with something like this, even though the asset price is going down, we're still getting consistent dividends. So you're still going to be paying on a monthly basis, which is great for someone that is retired or for someone that's using that money to accomplish something specifically. The last thing I want to point out is the large dividends that came out in December. So these were actually announced, even though it's dated here December 1st, that's just because it's for the month of December. This won't be paid out until January 7th. And it is a 49.9 cent dividend for QYLD. We have a almost 31 cent dividend for RYLD and a just under 50 cent dividend for XYLD. So why is that important? Well, it's almost double for QYLD what we normally get. And the crazy thing is I can't find an exact reason as to why it's so high. The only thing I found is that it is a short-term capital gains payout, and it is not the actual dividend, but it is replacing the dividend for that month. So you're not going to get two dividends. It's not something separate. It is the distribution that you're going to receive for the month of December. If you have any more information on this, feel free to leave it in the comments down below because I'd love to learn. So what do we learn from this? Well, even though QYLD may have been the worst overall return, that doesn't mean that it's a bad investment. It doesn't mean it was a bad investment in 2021. It just didn't benefit from the share price appreciation that the others had. However, like I said before, when we invest in these funds, we aren't investing in them for the share price to go up. I would be perfectly fine with the share price staying exactly the same. The majority of people that invest in an income ETF, such as QYLD or RYLD, they are looking for monthly income that's consistent to help them pay their bills or to pay for things specifically. I saw a really cool example on YouTube from a guy, I think it's called Father and Son Investing. I've actually never seen the channel before, but I watched the video and I was pretty impressed just by the idea because it's exactly the idea that I've said in my videos and also what I plan on doing in the future. What they said is you have a choice. You could buy a car today and pay $500 a month for the next 5 years. These are just random numbers. Or you can decide, I'm not going to buy that car today. I'm going to stay driving my used car or whatever's cheaper option. Take that $500 a month that you would have paid for your new car, a little bit of delayed gratification, put it into QYLD every single month. At the end of a little bit over 5 years, your monthly dividends from QYLD will be around $500. You'll actually be making enough money from QYLD to pay for your car that you want in the future. So one thing I've talked about a lot in my videos is I have a 10-year goal. I have a retirement goal, that's separate. But for my Robinhood brokerage and my M1 brokerage, I have a 10-year plan. I'm building it up as much as I possibly can. I'm holding on to delayed gratification in hopes of my assets appreciating, getting high dividends in the future so that maybe I can inflate my lifestyle a little bit when it comes time. However, maybe I'll just decide to retire early. Who knows? It's going to be up to my family and I, and we'll go from there. But more specifically, to end this video, what I want everyone to know is my specific investing options for 2022. I have slightly changed them. I am going to start putting more money into RYLD now because I like the fact that it's more volatile. At first, I didn't like it, but now, because I don't really care what the share price does if it goes up or down, the thing about covered call options is the more volatile a stock is, the higher premiums you're going to generate. So I personally feel like we're going to get higher dividend returns from RYLD in the future than we are going to get from something like XYLD or QYLD. Now, I could be completely wrong, who knows, but that's my personal opinion. So I'm gonna start putting more money into RYLD. I have a lot in QYLD already, so I wanna start to balance it out, but that's my personal opinion. But that's my move for this year. So if you're still watching the video, make sure you smash the like button down below. Subscribe to the channel. We do weekly videos on all things finance. Leave me a comment. Let me know what you plan on doing for 2022, and I hope to see you guys in the next video. Take care.